evening. Over the next 10 minutes, I'm going to be doing an introductory. Good evening, Sarah. Good evening, Andrew. I'm going to be doing an introductory session to bank reconciliation statements. This is going to go on for perhaps 10 minutes. We're just going to look at a few of the basics of bank reconciliations. So the aims and objectives here are to look at the bank reconciliation statements. We're going to look at why a cash book and a bank statement might be different, and we're going to learn how to prepare a bank reconciliation statement. First of all, the bank statement. Now, the bank statement is prepared by the bank. It's their own statement, just as the business will prepare its own cash book. The cash book and the bank statement should be equal, and if they aren't equal, there must be a reconciliation between the two. Typically, a bank will issue a statement at the end of the month, and this is the statement that will be used against the monthly cash book to put together a reconciliation. If the two are different, we'll be looking for timing differences to explain why they're not the same. So we could be looking for unpresented checks. These are checks that have been written out and signed by the company, sent out to suppliers, which have not been paid into the bank or recorded in the bank statement. They will appear, but just not in time to be included within the reconciliation process. Also, we have outstanding lodgements. So if, for example, a payment's made into the bank and that's after the close of business, using a night deposit function perhaps, then these items will be recorded as going into the bank in the cash book, but they will not appear in the bank statement. With the difference between the bank statement and the cash book, the first thing to do is to go through the bank statement and the cash book and to look at what reconciles. Most of the items, hopefully, will be identical, and the reconciling items can be taken out. This is in old-fashioned accounts called a ticking exercise, where you have two pieces of paper and you go across them, tick tick, one on the other, to look at what's left. And the items which don't have a tick on both pieces of paper are the ones you're interested in for the reconciliation. So within the bank statement, we're going to be looking at perhaps back payments. Here, customers have paid money into the bank. Perhaps they didn't issue a remittance advice, and therefore the cash book rather wasn't updated. We're looking at dividends received by the bank on shares or other investments held by the company, and interest received for credit balances. Against this, there's also money out, which hasn't been recognised in the cash book. So we could be looking, for example, at standing orders. We could be looking at direct debits. Standing order, obviously, we are looking at an instruction from the customer to pay a regular sum of money out of the account. Direct debit gives permission for an external supplier of services or goods to deduct the exact amount. If you think about possibly your energy bills, they're probably taken from you by direct debit in the UK, and you have no real idea how much is going to come out. So a standing order is predictable, should be in your cash book, you know how much that's going to be for. A direct debit, you have to wait until you're told how much that deduction was before you can accurately record it in your cash book. Bank charges and interest might also come out. These can be hard to predict, and they can be hard to predict, and again, you need to wait for the bank statement. Hello, Andrew. The standing order is set up for a fixed sum, but can be amended to meet the requirements. But typically, standing order will be set up for a fixed sum, and it can be for a fixed period of time. So, for example, it expires after a year, or it can be an ongoing thing. But standing order is just for a particular sum of money, which changed. No problem at all. Dishonoured checks. By paying checks into the bank, do hope that they will be honoured, but occasionally they're going to bounce. Customer doesn't have enough money to honour the check. These will show in the bank statement. The bank statement might be the first indication you've had that this has happened. Obviously, if you've had a letter, you're going to have updated the cash book to show that the expected funding didn't arrive. So finally, we've looked at the reconciliation. We've looked at uncredited checks, we've looked at unpresented checks, we've looked at direct debits and standing orders. Those items now go into the cash book. Now we look at the cash book and we do the reverse job. So it's not in the bank statement, but it is in the cash book. That's a difference that needs to be recognised. The big one here is payments by cheque which have not yet been cashed. That's going to be a big difference. And again, cash or cheques paid into the bank which haven't been recognised by the bank itself. Once these are put together, the balance should be equal to the balance in the adjusted cash book. That's the nature of the reconciliation, is by putting together cash book and the bank statement. The reconciliation itself marries the two together and explains why there is a difference. Do you have any questions, students? Please, not too hard. Okay, just to say to you, if you do want to have an explanation of this, please feel free to email me. You have my details through the website, and I'll be happy to answer any questions you have or explain anything in more detail if it's not quite clear. And remember, we're here to help you to learn. We're here to develop you. So please don't worry about asking questions. It's the most important thing about being a student. Shall we have a break? Thank you for your time, Andrew.